Thanks for tuning into the All Once Network podcast. My name is Mike Schroeder. Today I'm joined by my co-host Skyler Steinke, and we are also joined by two guests, Matteo Pandolfi. Matteo's he's our second time guest. He's the co-founder and CEO of Pareto, an on-chain private credit marketplace for institutional borrowers, lenders with over $200 million in TVL and over $2.5 billion in credit expanded. We are also joined by Thibault Labidi. Thibault is the Director of M11 Credit. He's an expert in on-chain and off-chain deal structuring who brings fixed income opportunities to capital allocators. So M11 team has underwrite the FalconX Credit Vault on Pareto, the biggest single issuer vault. So really excited to have you guys here. Thanks a lot for joining us.
And of course.
Thank you, Mike.
Awesome. Well, let's kick it off by just kind of setting the stage. Matteo, last time you guys were on the show, TVL was about $50 million. Today, you guys have surpassed $250 million in credit expanded. Walk us through what's changed. How has the market changed? Start us off there.
Yeah, absolutely. Well, I would say that, the raw numbers are really great, but, are just the scoreboard. It's not the game, But I believe that over the last year, since the last time we spoke, actually changed is, trust in this kind of asset class, especially on chain. And I believe it changed because two things finally compounded over the last year. The first thing is that borrowers with, on-chain credit facility have been able finally to build a credit history. When an institution borrows through an on-chain facility, every drawdown, every repayment, every covenant it holds is recorded immutably and publicly. So, after a year of these facilities operating, the borrowers who performed now, they now have an on-chain track record that is permanent. It's verifiable, it's portable, and, it's something that in traditional credit, this, lives in a private, sealed, or in general, it's impossible to check. And I believe that lenders have been rewarding that and the scalability demonstrates that the reward is actually hard on that side. And, a borrower with 12 months of flawless, verifiable repayment, is simply a different credit than one with a pitch deck. And, capital flowed accordingly. So I would say that would be the first reason. But I also would say transparency, raw transparency isn't enough on its own. And it's also where underwriters like Maven 11 Credit here have been paramount. On-chain data is just data until someone underwrites it, structures it, and turns it into a credit profile that a lender can actually read and price. So the diligence that Maven 11 and other curators like them did over the last year is what translated all these raw history into a clear, legible credit history. So that's what moved the institutional lenders from something that is interesting to I'm comfortable allocating, and it's one of the main reason confidence in this asset class stepped up a level over the last year, I would say. And lastly, I would say something that I saw in the market is also that composability finally played out for real. A year ago, composability was mostly a goal, was mostly, a promise. You'll be able to use the position as collateral, for example. That happened actually over the last year. The FalconX facility is one of the biggest collateral morpho. Exactly.
Yeah.
And but it went much further than just collateral in the sense that an entire ecosystem of service has been building and is now building around facilities like the FalconX one, from automated leverage and the leverage of a position of morpho to instant liquidity to secondary markets, for example. So to be honest, I'm losing count of the teams that are building automation and tooling around on-chain credit facilities right now. And that's great, I would say. And, every team, every service that is built around on-chain credit facilities allow the asset class to become more and more mature, more liquid, more flexible, more usable in ways that even, traditional private credit structure cannot really match. So I'm really proud of that part because I see that there's been an ecosystem push on making
Yeah.
also the asset class grow. And in general, like as we build the rails, now the ecosystem is building itself on top of them. And that's, when it's real.
Yeah, I love it. All right, we got a lot to unpack there. Thibault, we'll get to you in a second, but Matteo, I want to pick up on you mentioned non-crypto native borrowers, so people like maybe PayTech, FinTech, uh, you know are also utilizing these credit facilities. So talk to us about where on-chain credit is kind of heading.
I would say that's one of the shift that I'm most excited about in the sense that for the first couple of years running Pareto, on-chain credit meant mainly crypto lending to crypto institutions, trading desks, market makers, crypto native counterparties in general. The problem with that is that structurally, that's reflexive in the sense that when the market turns, every borrower in your book is stressed at the same time because they're all exposed to the same beta, technically speaking. What's happening now is that with onboarding other kind of like verticals in terms of borrowers, say fintech companies, say pay tech companies, you're extending credit to businesses whose revenue has nothing to do with the price of a token, for example, or has nothing to do with the correlation of the crypto market. And there are two things happening when you do this. First, crypto stops being the product. It's the actual rails that crypto and blockchain provides that becomes the product. And because these borrowers don't really care that it's on chain, they care that origination is faster, they care that settlement is cheaper, and reporting is quasi real time, for example. So that's what happened when you move outside also of the crypto market as a borrower base. And the second one that I see is that which is also the part that institution really care about, is that the risk base decoupled from crypto. A book that lends to a payment company, a fintech lender, and a trading desk, a crypto trading desk, is diversified in a way that a pure crypto book can never be, So
Right, right.
the reason we can even do this now is because compliance and onboarding layer are becoming better, I would say, and proper counterparty verification, a curator and underwriter that institution trust, for example. That's what lets a non-crypto business also borrow here without taking on all the crypto baggage. So I would say that's like where on-chain credit is heading. It's heading where on-chain credit stops being a crypto story and becomes just a better way to run private credit. The technology kind of become invisible, which is exactly what we want as an infrastructure provider.
I thought that was interesting, just talking about the risk profiles as well relative to online credit. Would you see that there's a risk kind of going down a bit, given more transparency, more real-time activity, more reporting around the mechanism, if you will?
I would say that it's easier to underwrite in this way. It's not completely like going down or changing completely depending on the business that is asking for credit, because of course there are intrinsic risk of on each kind of business line. The difference here, especially for institutional allocators, is that risk become easier to underwrite and more visible to them, which also provides a way to implement better risk management tools, for example. So it's not disappearing, it's not going down. The risk that we see that are common, for example, in TradFi will be the same that we have also on chain credit with on chain credit. The difference is a better structure to be able to underwrite them and manage them as well.
Excellent. So I guess the underwriting process, is more, you said risk management is better. Underwriting can be faster, which can get through more deal flow and things like that, would you say?
Exactly. Correct.
Got it. Excellent.
And then Thibault, it's a good time to bring you in here for the listeners that haven't heard of Maven 11. Who are you? What does M11 do? And what does the Curator actually do in the Pareto model?
Yeah, no, sure. So Maven 11 for the group part. So the name Maven 11 is more like known for the VC team that exists for 10 years plus in the space. But then we expanded the business, and one of the business in the group is M11 Credit, which is a single entity by itself. And M11 Credit is the actual kind of so-called curator working with Pareto. And to define exactly what we mean there by curator comes from these concepts from the money market morpho of someone setting up functions in the smart contract. I think that's still something we do, but we do it a bit more as an administrative agent, if we may use this term nowadays, and that's the term we use with Pareto. Or for example, we did it by the past by being called a delegator on top of the Maple pools. So there was a lot of different terms out there, and we sat and together and aligned on the fact that for the fund administration side of things, the Curator term setting up these functions is still there, and we are administrating them. And when we talk about the more curator roles with Pareto, it's also including the fact that we are looking into the collateral, organically, underwriting the borrower and setting up all the covenants and rails for the deal to happen, just like a normal risk underwriter or investment manager would structure a credit deal in TradFi, right? And that is something that needs to be defined in this term, because otherwise people may not differentiate the different credit vault from each others. And so that's something we really worked together with the Pareto team.
Got it. And you guys are essentially providing like the AML KYC, I would say, for these borrowers.
Well,
right?
no, there's a lot of services coming in the different roles that we have. So if we talk about the administrative agent role, it's mainly using Pareto to net inflows, outflows, curate the actual epochs of an evergreen facility in the case of the FalconX product. But there is potential for other facilities tomorrow, revolving or more fixed terms type of facilities. And we just make sure to provide LPs with fact sheets or loan notices based on the legals that we drafted, and all these different services that are actually coming back to this token that they have in their wallet and what they see based on that. And if we talk about the more collateral agent role, that is all coming back to how we originated the deal, what type of covenants we put in place to make sure the borrower is funded in a ring-fenced environment. So if we have to build an SPV in the middle, if we have to monitor certain type of information organically in the activity of, for example, FalconX, and build agents on or monitoring alert system to provide to LPs or to use it privately for us, because it's private information we have from the borrower, but we are still in a veto kind of position with right to trigger and pause the facility as the collateral agent. So that's really kind of a legal ownership on our side, or should I say we can interact and we can really just stop the facility with the collateral agent, which is a lot more critical. This is where the reputation basically and the restructuring role of M11 Credit comes into play.
Cool. Walk us through how a credit deal gets done. So, first contact with the borrower all the way till, capital is deployed. And, maybe we'll just start it there from the top.
Yeah, of course. I mean, historically, or for this FalconX deal, indeed we talked, and thanks to the network of Maven, mostly to on-chain or CFI, should I say, type of borrowers or people that are running an activity and are looking to offload a part of their balance sheets, are ready to put some collateral in place and are looking for a team to help them structure the setup and just pull together capital so they can fund their activity. The goal, as mentioned with Pareto and Matteo right there, is okay, we could originate other borrowers, and that's coming. Obviously, the pie should grow. It's just a matter of acculturation and maturity at this point. So once we originate the deal, it can be a deal coming from a partner, a deal coming from another, prime broker in the space, or just fintech. We just abstract the fact that we're in crypto, and really coming back to what Pareto is saying here, Matteo is saying, is that we are talking about rails, right? To do some credits, and the end goal is just to fund an activity, mostly in a very stable currency. So we abstract all these complexity for the originated borrower, and then we look into what type of collateral they can provide, and it all comes down to building this legal package that comes down to a credit agreement, and an SPV setup that is just like a warehouse credit traditional facility that you can think of. So once you got this packaged SPV, ring fenced it, collateralize it, maybe add a buffer of participation by the borrower to have skin in the game with the LPs tomorrow, and ring fence the activity that you fund, you can look on, okay, no, I want to distribute this facility. And that's where and when you reach out to teams like Pareto and you look into their capacity to integrate all these covenants in their tech stack, right? And I think it's very important to mention that, 2 years ago, we launched this product now. No, not 2 years ago, a year and a half ago, and the market and maturity was different, and Pareto was really putting resources on to look into the different legals we had in place with FalconX and adapt the protocol, the functions, and so on to meet the terms. And that's how we ended up having a very nice tailor-made facility there. On our plate, then, once distributed, or should I say, while building this with Pareto, we also went a lot more into the due diligence of the activity directly of FalconX. So what are we funding in this product, for example? If we talk about FalconX, is that we participate into their loan book activity. So they have this trade desk of a certain size, and we build an SPV they can pull money from to participate into loans. And we monitor as a collateral agent exactly what loans they want to put in this facility, right? And this is also our collateral agent role. I can say, okay, the loan that you want to participate into is backed by an asset that I don't trust as a collateral agent, so you won't participate into this loan, right? That's the role of M11 Credit as a covenant, an agnostic underwriter. And then we also look into maybe the track record of the performance of their activity. The loan book of FalconX obviously is running under a risk engine, and this risk engine liquidate the positions or margin call people, right? And so we looked into the loss given default of their historical activity, and that ultimately was our way to then build inside the facility and at the SPV level a 10% first loss buffer that covers this loss given default ratio on a quantitative basis. So there is a lot going on there on our plate when it comes to structuring the deal, and it's taking a long time on the legal side. And then once everything is packaged and the deal originated and maybe some bootstrapping partners lined up, we distribute it together with Pareto, and then we integrate it, and we come down to this ecosystem integration in DeFi using the rails, composability, and so on for capital formation. So from the deal to the distribution, there is a long way of structuration.
Yeah, got it. And I'm gonna pull up this chart real quick because I saw you guys this is listed on the FalconX website. So I think this is a really good walkthrough for people to see. And for those listening, so basically you got the investors, they're putting their capital into the credit pool. FalconX is essentially lending this out to other borrowers. The borrowers are giving FalconX collateral. And then at the end of the day, the users are getting yield from this.
The diagram you shown is a good one, and it shows that we participate into an existing activity of FalconX, right? We're plugging to their activity, and they basically have their Rolodex of borrowers and their loan book, so we can participate into it and give people on-chain exposure to it, which is a performance that did not existed in the on-chain, world, which is a new source of yield people are eager to get exposure to, right? So for capital formation, it was a great way to arrive to this market and say, okay, here is a new type of asset that you guys cannot really access nowadays. And this is a very efficient and optimized way to access it because we are using all these, rails of credit and Pareto for tokenization and distribution. So yeah, it can be done with other industries, other activities, and yeah, diversifying the sources of yield for the LPs on chain is probably also a good way to mature the ecosystem.
Yeah. And there's a lot of components there, T. But I'm just curious, from going from an on-chain underwriting process from a traditional process, there's a lot of monitoring. You mentioned a collateral agent, that process, exposure in real time, not quarterly in the traditional sense that we see in the traditional market space, or maybe monthly in certain cases. How's that change? We talked about risk management. How's that change the risk management profile, or just how you manage the risk on a daily basis in that case when it's real time?
Yeah, well, it's very easy when talking about it. It's very easy to separate, the two underwriting and really look on chain, really look off chain, and package everything on our side. That's our job. However, I would say the biggest challenge is also just to speak the same language as everybody, and that will be, I assume, even worse going forward whenever these rails for funding, not talking about crypto, but talking about the rails for credits being optimized through crypto and stable coins, we will see more borrowers looking into these facilities that are not very familiar with such setups. And when we underwrite on the borrower side, so leaving a bit maybe the on-chain underwriting for now, it's very specific to their industry, very specific to what they do. And so far, by the background of Maven being very crypto native at first as well, we worked with more CeFi oriented people or DeFi even oriented people on the borrower side, because we also understand that it's part of the network of Maven being a VC in the space for a long time. And tomorrow we will probably need more of these underwriters being specific to an industry, but they will also need to understand the on-chain maybe capacity and tokenization. So maybe Pareto can plug there as well, but they need to reach these people, or maybe we can also be a bridging facility for them and help bringing everybody in the same boat. I have to say, if we then look on chain, this is also a very wide spectrum because it can be only for the distribution parts. And then it's more like the administrative agent role supported by Pareto on looking into who's depositing, who's getting out, who's getting liquidated in the secondary market, who's actually, playing around with with the receipt token and what's happening on chain there. But maybe it can also organically then go into the borrower because the borrower is using the on-chain rails as well into its activities. And so that's where we see more of these fintechs coming into play, receivables being on-chain, or maybe some of these activities we are looking forward to just underwrite a lot more on-chain on the board side, because that's also our bread and butter. And that's where we believe we can have an edge over some specific industry underwriter that will just look for a new source of funding and turn to the on-chain world because it's a capital they never thought about sourcing because they never accessed it.
Yeah, with when it comes to like collateral, uh, maybe a question for you, Matteo. Like what type of collateral are people giving? I mean, Bitcoin's obviously comes to mind. Are you guys using like RWAs? Kind of what does that aspect look like?
Well, in terms of the collateral, if we take the FalconX facility as an example, well, the collaterals are tied to the covenants that Maven 11 is actually has been setting up at the beginning of the facility and now monitoring over time. So it's a variety of different assets with like a sort of safeguard given by the market cap and the liquidity that is present on these assets. Other kind of collaterals for the facilities that we have, just to let you understand like the kind of infrastructure that we have. We usually say that we cover full spectrum of collateral, which means that we can go from on-chain pure on-chain collateral with a bit more flexibility, let's say with margin calls and grace periods to top up the collateral, to off-chain kind of collateral. This is the
Okay,
example with
this is good to know.
FalconX where
Yeah.
there's an off-chain book where there are collaterals, but it's held on custodians or qualified custodians or centralized exchanges account, but allows still to fund these activities through an on-chain credit facility, to even like moving more and more into the unsecured kind of loans area. Of course, from the experience that we got since during the last year, I would say most of the, let's say, unsecured loans are really against the balance sheet of a fund or a corporate or a corporation, for example, and they come with, for example, parental guarantees or like other kind of covenants, like even an equity cushion, a junior tranche, for example. So the collateral that we can accommodate, that we can work with, are pretty much a wide range, in the sense that we can work with this full spectrum of collateral. Of course, we believe that, especially for credit, it's a reputational game. So you don't, like, I don't see on-chain credit growing by just, closing an eye on the diligence part and just trying to serve every single borrower that tries to get on chain, because before getting there into, let's say, microcredit style of loans or even like emerging countries credit, you need to have a resilient infrastructure and risk management tools. So, I mean, from a collateral perspective, we are starting from the solid one and step by step going towards more and more like kind of unsecured into the unsecured area.
Makes
But yeah,
sense.
from a
Yeah.
technical perspective, the infrastructure has been built to be able to work with this full spectrum.
Yeah, yeah. I mean, it's the future. It's like, I mean, when I get my car loan, like I put $0 down. I got no collateral.
Exactly.
I mean, the car is a collateral at the end of the day, but okay.
Indeed.
Um,
Yeah.
yeah, go ahead, Skyler.
No, I just okay, you brought up the FalconX kind of facility just in our previous kind of thought process there. Just would you want to mind walking us through that FalconX Credit Vault behind the scenes? Kind of just what was the deal? Initially, how did it come together? What what made it different from anything else that has been done at that scale on chain at this point?
Yeah, no, happy to take this one. So maybe getting back to you know M11 Credit and why FalconX at first. It's mainly because we operated credit on chain for a couple of years now. We started in 2021, and following the FTX event and what happened at during this period is basically us sitting in a room and asking ourselves, okay, how can we just service the same type of Rolodex we had and worked with, which are the hedge fund, market makers, and trading firms of this world that are on chain or sourcing capital on chain, but make it collateralized or at least ring-fenced and secured. And we basically brainstormed with most of the prime brokers out there because we figured, okay, if we fund the loan book of a prime broker, we still are backed by first the risk engine of a prime broker, which is top quantitative risk engine, and secondly, all the pledges and covenants and junior tranche and other covenants we can think of that we design and structure as long as we source a prime broker that wants to do this with us. And I think 2 years ago, it was a difficult time for teams like us to source people that actually wanted to put some resources and effort on building some structured, secured facility, because there was still room for unsecured credit in the on-chain ecosystem. And there is still a lot of unsecured activities there. But back in the days, I think the teams were less willing to put collateral in order to build such a facility at scale. And FalconX actually was, in the discussions, very willing to do so, and really saw early on an opportunity to offload part of their balance sheets in a secured manner, but also sponsor maybe an on-chain footprint that they are actually and actively building nowadays, and just saw growth and opportunity in this deal. So that's how we ultimately sourced them. But then we also designed everything from scratch based on some very TradFi legals that we adapted to the on-chain world. And sometimes we still face some issues with the wordings there, but that's normal. And making it compatible, being at the forefront of this was very exciting, and we did it jointly with Matteo here. I still recall building these flow fund charts and trying to match these credit terms, very traditional
Yeah.
ones, and asking myself, yeah, well, we have an issue there because the vocabulary don't even match. And that was a year and a half of hard work on the structuring side, I would say. And we launched the product actively on January 2025. We had, a very healthy launch and period initially, with very high rates because it was still during the period where the basis trade of DeFi were very high and the board demand very active. So we launched at a very good rate, and then the first teams to integrate provided the tool to compose, to leverage, and then we had the first looper, and then the first morpho market, money market, and then the first curator stepping in, and then LP started looking at the product a lot more for what it was, because it was very easy to do capital formation once people started talking about it. And then the basis trade maybe of DeFi went down, so actual private credit narrative went up, and that also helped bootstrapping some volume in the product, as the DeFi yield fund were maybe the most active in such areas, but looked for new sources of yield. So I would say we had very strong partners to help us build TVL there. And now the goal is to go reach more institutional people distributing these assets in such banks or just to private funds.
Mm-hmm. What is it, on that note, what does it take for institutionals to get comfortable?
Well, the counterparty risk, the fact that it's FalconX, most of the institutions looking into it obviously know the team, right? And they just like the fact that it's structured in very ring fenced and collateralized manner, because the other opportunity they have is to be a direct client to FalconX. But no, FalconX is also saying, okay, yeah, well, we also have this conservative exposure to our book if you want. So that's one. But then I would say, looking back, they're really looking to distribute such private credit, exposure if tokenized, or just abstract the tokenized part, because they do have on-chain activities and they're looking for very strict, over collateralized opportunities in the space. And I would assume there's not that many still in the space nowadays.
Yeah. Matteo, anything to add on your end?
Well, for an institution to look into, well, for example, the FalconX facility or other facilities, of course, uh, I would say, as Thibault mentioned, the diversification of the kind of yield sources that they're working with is definitely like a key component. But I would say also the compliance layer that we have been working on compared to, let's say, other vaults. Now, vaults are getting quite of a trend slash discussion in the space, I would say, and it's right. It's the right direction, in my opinion, because we need these kind of discussions. And but yeah, the compliance level that a credit facility like the Falcon X1 is providing is something that was missing in the space, especially for an institution to be able to deploy. So, you know what changed, and also what was different for institution with this kind of on-chain credit facility was that the compliance requirements were meeting their own requirements. You know, the compliance list that we have for FalconX was meeting their requirements. So it was really easy for them, for our investment committee, for example, to be able to say, okay, that's something that we understand. It's different because it's more composable, it's on chain. We need a wallet to be able to deposit into it. But to be honest, compared to like 3, 5 years ago, that's not really a barrier anymore. And so yeah, I would say the fact that these institutions were able to recognize and understand the product without too much jargon around it, but understand also that there were, you know, additional use cases on top of that, and not just, you know, some funds that are parking into a credit instrument. It's something that moved the needle with institutional players.
Yeah. To that point, Matteo, just talking about vaults, that's a big hot button and topic for many people right now. What is the kind of the biggest driver of opportunity with vaults, and where do you see the demand in real time here?
Depends, because I would say vaults haven't really found their own the right definition, because
Yeah.
everybody's using vaults as a name, and it might be a bit misleading at a certain point, in the sense that a vault could be something completely based on programmatic rules, something that is discretionary in terms of allocation. So that's why I was saying I'm really happy to see the discussion coming out also from a legal perspective, because it brings more clarity at the end of the day.
Yeah.
And that's what's
Right.
missing in vaults at the moment, because especially if you think about investor protection, the more complexity and the fact that it's not that clear of a definition, that makes everything worse from a compliance and regulatory perspective, but also purely from an allocation perspective for an investor that decides to allocate funds into it. So, to be honest, I mean, I'm proud to see the discussion coming out, because it brings more clarity around the definition, and probably I would say we will see other terminology coming out in on-chain finance and DeFi in general, which is much needed, in my opinion. And so we can give the right name, the right nomenclature. The same kind of issues that we had with FalconX at the beginning, when the
Yeah.
credit team was proposing up us terms with specific nomenclatures, and from an on-chain perspective, there was a completely different like names, but we were talking about the same stuff. I think with this kind of tough process should be applied also to the ecosystem, specifically talking about vaults, to the ecosystem as well now.
Yeah. I think you both have kind of mentioned the different terms and trying to get on the same page. How do you execute a legal framework programmatically, and enforce that legal framework programmatically, right?
That was quite of an exercise at the beginning, but I would say it's been a paramount component of us building Pareto at the beginning. And indeed, we're really thankful for these with to Maven 11 and FalconX, because it's been the right, sandbox in order to be able to understand what were the needs from this kind of institution, both from an underwriter perspective to a borrower perspective, to understand what kind of features our protocol needed at the time, or what features we needed to focus on and prioritize compared to others. And again, it's been quite of an effort at that time, but actually I've been kind of surprised at a certain point where lawyers in general, legal firms, we're fine to include, let's say, okay, in this contract, if you want to define the interest rate, you need to call this function on chain. So it was kind of the first time that I saw essentially a legal contract communicating to a non-chain contract, a smart contract, and vice versa. So the smart contract listening to events that the legal contract could define, could trigger, depending on certain conditions. And so, yeah, it's been really paramount in order to be able to build flexibility on Pareto, which we believe is one of the design choices that also allowed us to scale up. Because our thesis is that, especially when we talk about credit, and as also Thibault mentioned, different businesses require different covenants, different kind of due diligence. So as an infrastructure provider like Pareto, you need to be as much flexible as possible and provide an infrastructure that can handle multiple kind of use cases and requirements from a borrower perspective, underwriter perspective, in general, origination perspective. So it's been a tough process, I would say, but all in all, it's been really important for the development of the protocol.
With receipt tokens, AA FalconX USDC is the number 2 RWA collateral on Morpho. What exactly are people doing with this token?
Well, I'd say that the main use case is definitely to leverage the position, right? So yes, the Morpho market, I think, was spun up back in May. May 2025, if I'm right. And that was when we had the first market and the first supplier of capital on the lending side, which was Gauntlet supporting the asset at first. And we had then our first LP cohort definitely borrowing at 77% LTV against the AA FalconX USD asset as collateral, and freeing up then some new fresh USDC based on their position at a borrower cost, of course, but then generating a carry trade because they could use this new fresh capital to enter the product again or do any other yielding activity, maybe more liquid or so on, to run a carry trade, right? That's, I believe,
Yeah.
definitely the biggest use case out there. But as you know, Matteo mentioned, that also evolved to just being the backbone to more DeFi use cases. And we now have also some other teams that are building auto compounding or auto leverage on top of such use cases more programmatically. It can be again in a vault. So yeah, getting back to the definition of a vault, it can be very different, right? It can be a vault that run
Right.
this and abstract this DeFi complexity and carry trade for people, and then that's operated by some curators out there. It can be some trenching facility, so that's also a DeFi use case, right? Where there is an additional layer of risk mitigation for people that really want a safe exposure to the asset, and some people want also maybe a less protected exposure and are willing to take a junior trench on that. And we also have, you know, the collateral itself being creating a secondary market for people that actually want to bid and quote to exit the asset, but faster than the designed principle. So that's the RWA, markets and secondary markets where people and takers and makers just bid on their position against a premium, and some market makers or other bigger players are willing to buy the position at a discount and redeem it directly with us because they also pass the KYB and so on to be able to redeem the principal. So I would say there is a lot going on in there, and we are very happy to be compatible, I would say, and that's something we really value.
Yeah.
We are permissioned assets with strong AML KYB requirements, but once you pass this, it's a permissionless asset, right? And
Yeah.
we believe protocols like to compound with it, funds like to compound with it, and a lot of people are just supportive integrating it.
Yeah, this is like, yeah, and for, I mean, for some of our listeners, they might just be, from the traditional finance side, so they're not really familiar with these type of products. But this is essentially, as a lender, I provide my capital. At the end of the day, I get this token. I'm earning that yield, and then you could do other things with it as well, right?
Yeah, exactly.
Um, do Yeah, I mean, how do you guys think about that from like a risk perspective? Is that, I mean, we've seen like stretch strategies products like I don't know, it's kind of went down a lot. I mean, are people doing crazy things with these? Like, I mean, maybe from the M11 perspective, are you guys, does it matter to you? I don't
No,
know. How do you think about like
it
risk?
definitely matters, right? It definitely matters. There is a reflexive risk. There is an integration risk. Obviously, if someone is if you integrate the wrong way, you will be able to pay the cost, right? There is still a risk, and we need to gate who's able to mint, who's able to redeem, and in order to gate what the use cases are on chain, because we have no room for inefficiencies, right? And that also compounds as you go for maybe some cross-chain exposures where you do have some omni-chain fungible tokens. Sorry for the terms, right? But that's also to kind of issue the asset on other infrastructures. So the more you integrate, the more infrastructure exposure you get, and the more risk inherent to the infrastructures and smart contracts you get. So that's very important. But whatever happens, basically, we always hold at the principal level the lender kind of registry. And this is our job as the administrative agent to hold it and make it, true to what it is, because we always have a, you know, proof and stamp of who's having what position in the fund, and we can always restructure it based on that, which is very important, and that can be vehiculated to be done off chain if there is something very dramatic happening. So we have these new kind of safeguards. So if there is an exploit somewhere, we will kind of gate and be able to monitor who's actually trying to redeem and kind of liquidate, let's say, the fund itself by being a malicious actor, getting the tokens in a way that I don't kind of monitor for whatever reason. Then I will always have this safeguard of, okay, I see a redeem request. Who is that from? Why is that happening? And so on. I can always monitor that. And we also have obviously deep integration in whoever is integrating the assets with like monitoring tools on chain, just to know if there's an exploit, if anything goes wrong, right? We obviously know that. So no, it's very important, and we are very true to ourselves at M11 Credit for this type of reputational risk. We know, and we discuss the boring side very off chain, right? But we are very proficient on chain. We also have, DeFi yield fund ourselves. We also have, VC activities of ourselves that are on chain, and we definitely know that you don't want to mess with this bridge, and you want to gate that. For example, if you open the door to a multi-currency setup, you need to do multiple vault. If you open the door to new class shares, that needs to be converted into multi-exposure, multi-tokens to the assets. You don't want to mix things together. And that's also maturity that we worked on with the Pareto team to orchestrate all this risk, but always stay at the middle to gate any exposure, any potential for a malicious actor to redeem. Basically, that's the point.
Yeah. Yeah, very interesting. I'm curious. We've talked about a few things here on you, Thibault. You mentioned collateralization and how maybe there could be different agents based on asset class, right? From an expertise perspective. Where do you see kind of the market going? And from folks who maybe in the audience are more on the traditional side, you're used to traditional private credit. Where is kind of the opportunity for them to step in? What trends are you guys seeing in real time here? Because obviously things are moving quickly, and how deals are put together in this framework.
Yeah, no, definitely, it's moving very quickly. So I assume these, private credit folks in more TradFi are still aware of the on-chain ecosystem, then a little bit at least, because yeah, otherwise that's where you should start to get access to
Yeah.
the asset itself. But yeah, no, I would say that once distributed, the asset once tokenized, it's out there, available for composability, available for everyone to get exposure to. And I would say, as an LP, there is just a need for tooling internally to make sure that you can get exposure to it, but the subscription is just more efficient. Transparency and all the different services that the on-chain rails and Pareto are providing, just, I think, give trust once you get the good knowledge of the infrastructure over maybe some intermediaries that we can know in TradFi. And the other way around is true if these private credit people are actually looking on the borrow side. I think that there is a lot of opportunity to borrow maybe at a cheaper cost, or to provide to a source of capital that is not currently reached by their industry, a new product that will, I'm sure, be welcomed by a lot of people very warmly, and a lot of people are willing to put their resources and efforts to build something innovative and efficient going forward.
Guys, could you guys give us a sense of the yields that we're looking at?
For this FalconX product, we are talking about a currently 8.25% growth rate, but there is a 10% performance fee, so that's leading the net yield for allocators around 7.4% net.
Matteo, I also have a note here. FalconX cut its operational load by 80% using Pareto. What did that friction look like, and how does the on-chain process remove that?
Well, I would say the 80% reduction comes mainly from all kind of practices that were embedded into the credit origination process at FalconX, kind of like traditional practices that were embedded. And running a credit facility or an OTC credit agreement the old way, let's say, involves a stack of manual, error-prone back office work. Settling every drawdowns, all the repayments across custodians, for example, reconciling position between the borrower's book and the lender's book, sometimes in a manual way, sometimes like with endless Excel files, calculating all the interest waterfall, producing the NAV exposure reporting and everything. For the audit, for example, every one of that is kind of like a person, a spreadsheet, a delay, a place a mistake can hide, essentially. So what we saw with FalconX is that most of these kind of loan, all of these elements of the loan life cycle can be automated from an on-chain perspective in terms of reconciliation, of netting, on interest distribution, interest waterfall. Everything could be automated from that perspective. So FalconX credit team now, instead of having to put resources on handling these kind of processes for the loan life cycle, they are just delegating that to the smart contract side of things, and so they can focus on other stuff like providing better reporting, better data integrity, or in general like being able to focus on their own business, on the prime brokerage business itself. So that's
Yeah,
where these
blockchain
80% comes.
efficiencies. Yeah.
Indeed. So yeah, that 80% essentially comes from operational overheads running facilities in a traditional way compared to what we have now with the on-chain credit facility that, for example, is even it's also syndicated, so they don't have to manage the credit relationship on a deal by deal basis, which makes it even more complex for the credit team to handle. But it's more syndicated, so all the terms, all the updates that get agreed on and defined on the credit side of things, also with Maven 11, getting automatically propagated across all the lenders. So that's another, operational saving that comes in by using the on-chain credit line. So yeah, all of these, I would say that that's also what matters with CFOs or COOs across the board in general. Like,
Absolutely.
it's not really about the yield that they're paying. The yield is a byproduct of the business that you're running. The operational cost reduction and the risk of running the less risk of running this facility in an on-chain manner is actually the reason to actually change how you operate and move from a legacy kind of infrastructure to an on-chain infrastructure. So, that's the number that gets the second meeting after the first one.
Yeah, I love it. Awesome. Well, I know we're bumping up on time here, guys. You did mention there's one new vertical you guys are finalizing. Maybe real quick, just tell us what's next for y'all. Where's all this headed?
So on our side, as briefly mentioned, opening up to other kind of verticals in terms of borrowers is kind of like the main next step. There is the fintech, paytech kind of area that is very interesting because of the lower technological barrier to be able to operate on chain. The second category that we see coming up, which is more and more becoming educated with on-chain technology, is actual like traditional institution, in the sense that like credit unions or like commercial banks that wants to use these rails to be able to fund credit facilities that they are already running, that they are already underwriting for like hundreds of years almost. So the main two verticals is still corporate kind of area, corporate loans, and commercial loans through institutional partners that already have the underwriting methodologies in place but want to upgrade the rails that they're using. Those are the main like the new verticals that we're focusing on. Last thing that I wanted to mention is that we're focusing on that via Pareto Studio, which is actually one of the new things that we're introducing, which is a sort of like a self-serve platform for originators to be able to originate credit facility. And,
It's like a white label,
it's
right?
exactly. It's kind of like the moment when we stopped being the only operator on our own rails. And strategically, it's also really important because the white label and the self-serve nature of this product allows an institution to launch its own credit facility on chain under its own brand, for example, and run the entire infrastructure underneath origination, borrower onboarding, and verification through Pareto rails. So, it's kind of like moving from just something productized into a platform where businesses and institutions can build on. So that's another new addition that is currently in beta, in closed beta, but we're opening up soon and we're really excited about it.
Yeah, I love it. I mean, it's great to see products like this really come into the market. It's like we talked about. It's like really. I mean, this blockchain efficiencies. It's the future. I love it. Thibault, is this? I mean, is this going to be a big part of M11's business? You see, I mean, you guys are. I know I've known Maven 11 as a fund. It's kind of interesting. I mean, do you see this growing to be a big part of your business?
Yeah, no, definitely. I think talking maybe taking a step back, and for the Maven even brand as well, we definitely see the opportunity in the credit on-chain ecosystem. We believe using tools like Pareto for it and to grow this activity for the group is definitely top priority. And I would say, to bounce maybe on what we discussed here, optimizing, getting better, getting maybe at the frontier of the best practices when it comes to collateral monitoring, and the actual collateral agent we discussed in the setup here is a top priority. So a borrower always need this agnostic underwriting service on the side, because structuring is a normal service, and we will make sure to be positioned there to meet the industry that actually need someone that understand also the on-chain ecosystem, and be a partner for these borrowers alongside Pareto.
Yeah, I love it, guys. Awesome. Well, where can we send people? Matteo, where can we send people to learn more about Pareto? Thibault, where can we send people to learn more about M11 Credit?
Well, regarding Pareto, you should definitely go to pareto.credit. From there, you can find all materials, documentation, and also look into the facilities that are currently live. And follows us on Pareto Credit on X and LinkedIn, because it's where we mainly publish all the new updates and new and news about the product side or the borrower side in general.
Yes. And for Maven 11, I would say the main website will showcase a lot where we come from as a team in DeFi, in this space of blockchain and crypto. And then from there, it's very easy to go to the Maven 11 credit specific websites, or Twitter account, or LinkedIn, where we post most of the news related to the FalconX product, but also maybe more going forward what we plan on doing when it comes to structuration, or the actual credit fund that we have in the house.
Very nice. Very exciting, guys. So Matteo, Thibault, we appreciate your time, and we'll make sure to put all your content info in the show notes as well. This has been a great conversation. We thank you both.